Lehman Brothers did not collapse because it was uniquely reckless. It collapsed because the system required it not to fail. In September 2008, when Lehman filed for bankruptcy, global finance froze within hours. Markets did not reassess value. They stopped functioning. Credit vanished, trust evaporated, and institutions across continents discovered they were exposed to a single node they barely understood. Lehman's failure revealed something deeper than poor risk management. It exposed a financial architecture built on assumptions of continuity, liquidity, and mutual confidence. When those assumptions broke, there was no backup plan. The collapse was not loud or dramatic at first. It was procedural, technical, and irreversible. This is the story of how one firm's fall became a systemic shock and why modern finance proved unable to absorb it. Lehman Brothers was founded in 1850 and evolved over more than a century into one of Wall Street's most influential investment banks. By the early 2000s, it was deeply embedded in global capital markets, operating across investment banking, trading, and asset management. Under the leadership of Richard Fuld, the firm pursued aggressive growth, particularly in fixed income and real estate-related products. Lehman was not an outsider or a fringe institution. It was a core participant in the financial system, connected through funding markets, derivatives, and counterparty relationships to nearly every major bank. Its balance sheet reflected the prevailing model of modern finance: high leverage, short-term borrowing, and confidence in liquid markets. In the years leading up to 2008, housing markets expanded rapidly, and securitization transformed mortgages into tradable assets. Lehman became a major player in this process. Internally, the firm believed it understood its risks. Externally, regulators and counterparties assumed the system could absorb losses. These assumptions shaped decisions that would later prove fatal. Lehman sold stability through sophistication. The firm argued that modern risk management, diversification, and financial engineering had reduced the likelihood of catastrophic failure. Mortgage-backed securities and related products were presented as tools that dispersed risk across the system rather than concentrating it. To investors and counterparties, Lehman offered reliability. Its long history, strong credit rating, and integration into global markets signaled safety. Internally, executives believed that housing declines would be regional and manageable. Models suggested that severe nationwide downturns were unlikely. Even if stress emerged, liquid markets would allow positions to be adjusted or sold. The broader promise was systemic. Banks trusted that funding markets would remain open. Regulators trusted that large institutions could manage themselves. Governments trusted that no single failure would threaten the entire system. Lehman was not marketed as exceptional, but as representative of a resilient financial architecture. This belief reduced urgency. Risks that would have appeared dangerous in isolation were accepted because they were assumed to be shared. The promise was not growth without risk, but risk without consequence. Lehman's expansion accelerated in the early 2000s. The firm increased its exposure to real estate through mortgage origination, securitization, and proprietary investment. Its balance sheet grew rapidly, supported by leverage and short-term funding. Profits followed, reinforcing confidence in the strategy. By 2007, Lehman held vast positions in mortgage-related assets, including commercial real estate and complex securities tied to housing performance. These assets were often financed overnight in repurchase markets, requiring constant access to liquidity. As long as markets functioned normally, this structure appeared efficient. Lehman's size amplified its influence. It was a major counterparty in derivatives markets, a participant in global funding chains, and a trusted institution for clients worldwide. Rating agencies maintained investment-grade ratings. Regulators monitored the firm but did not intervene decisively. Internally, success validated assumptions. Warning signs in housing markets were acknowledged but discounted. Declining asset values were treated as temporary. The firm continued to hold and roll positions, confident that time and liquidity would resolve stress. Lehman's power was not dominance, but integration. Its scale mattered because it was woven into the system itself. The system failed when liquidity became conditional. As housing prices fell, the value of Lehman's assets declined. Counterparties began questioning the firm's solvency. Funding that had once been automatic required reassurance. Margins increased. Haircuts widened. Each adjustment reduced Lehman's ability to operate. Lehman's problem was not insolvency alone, but timing. Its assets were long-term and illiquid. Its liabilities were short-term and mobile. When confidence weakened, the firm faced a mismatch it could not resolve quickly enough. Attempts to sell assets were constrained by falling prices and thin markets. At the same time, regulatory ambiguity intensified the crisis. Unlike other institutions, Lehman was allowed to fail. There was no clear framework for resolving a large investment bank. Potential buyers hesitated, uncertain about exposures and political support. Negotiations stalled. As the prospect of failure grew, the system reacted defensively. Institutions reduced exposure to Lehman and to each other. Interbank lending slowed. The fear was not Lehman's losses, but uncertainty about who would be next. When Lehman filed for bankruptcy, contracts were frozen, collateral was trapped, and payment flows were disrupted. The failure propagated through the system, not through asset losses alone, but through operational paralysis. Markets that relied on trust and continuity discovered they had neither. The breakdown revealed that diversification had not eliminated risk. It had redistributed it into forms that were harder to see and impossible to isolate. Lehman Brothers filed for bankruptcy on September 15, 2008. Within hours, global markets reacted. Money market funds faced runs. Equity markets fell sharply. Credit markets seized as institutions hoarded liquidity. The failure was treated not as an isolated event, but as a signal that no institution was safe. The immediate impact was confusion. Trades were unwound. Legal disputes emerged over collateral and obligations. Firms struggled to assess exposure, unsure which contracts would be honored. The financial system slowed under the weight of uncertainty. Governments and central banks responded with emergency measures. Liquidity facilities were expanded. Guarantees were introduced. Interventions once considered unthinkable became necessary. Lehman's collapse marked a turning point. It demonstrated that allowing a major institution to fail without a resolution mechanism could destabilize the entire system. The shock was not proportional to Lehman's size, but to its position. What failed was not just a bank, but the assumption that markets could absorb unlimited stress. The aftermath reshaped global finance. Regulatory frameworks were revised to address systemic risk and resolution planning. Capital requirements increased. Stress testing became standard. Central banks assumed a more active role in crisis management. Yet the deeper lesson was structural. Lehman exposed how interconnected modern finance had become and how fragile that interconnection was under stress. Losses were significant, but the greater damage came from uncertainty and loss of trust. Lehman ceased to exist, but the system it revealed remained. The reforms addressed symptoms, not dependence. Markets resumed, but with a clearer understanding that stability was conditional, not guaranteed. Lehman Brothers did not break the system by failing. It broke the system by revealing how much depended on continuous belief. Modern finance was built to optimize efficiency, not resilience. Liquidity was assumed, not secured. Trust was implicit, not earned. The collapse showed that systemic risk is not created by size alone, but by connection. When institutions are deeply intertwined, failure cannot be contained. Lehman's story is not a warning about excess, but about architecture. Systems that function only under perfect conditions will eventually face imperfect ones. When they do, the cost is not measured in losses, but in the sudden absence of confidence that once held everything together.